Hey guys, this is Abid. Welcome to Trade Options Like a Pro by Sensibull. We will learn what are call options, how to calculate profit and loss, and when to buy and sell call options.
To understand options, you first need to have an idea about what future contracts are. So let's take an example. INFOSYS is trading at 900 rupees right now. You want to buy the stock next month, say on the 30th day, around 900 rupees. As a buyer of the stock or a prospective buyer of the stock, you are worried that the stock price will go up. So you want to protect yourself from this happening. So you come to me and say this: I will buy INFOSYS from you at around 905 rupees next month on the 30th day. I like the deal, I agree to it. So on the 30th of next month, you will come and purchase the stock at 905 from me, and I will sell it to you at 905. That is a futures contract. Next, we look at an options contract. Let's add a twist to the previous premise this time. You want to buy INFOSYS at 900 rupees next month, say on the 30th. You're worried that the price will go up. This time, you come to me and say, I will buy INFOSYS at 900 on the 30th of next month from you, but if I feel like. Obviously, I don't like it one bit, so I say no to that. But then, once my initial anger response is over, it got me thinking, what does your deal actually mean anyway? You have a right to buy INFOSYS from me at 900 rupees on the 30th. I have to sell INFOSYS at 900 to you, which means you buy it from me when INFOSYS is above 900 on the 30th, and if on the 30th INFOSYS ends up lower, let's say at 850 rupees, you won't buy that from me. Instead, you will buy it at 850 from someone else in the market. Long story short, you have an option to buy INFOSYS from me at 900 rupees. So we are going to call that an INFOSYS call option. To fully understand this deal, let us see what happens at different price levels on the 30th next month. When the price is below 900, you won't use the option to buy it at 900. You would rather buy it from market at a price below 900. At 900, you can either buy from the market or from the option seller, it doesn't matter. But above 900, you will exercise this option. That is, you will buy it from me at 900 rupees. So let's see what happens when it goes above 900. When the price is 901, you're buying the stock which is worth 901 at 900, which means you're making a clean 1 rupee profit. If I did not have the stock with me at that time, it means I will have to buy the stock at 901 from someone else and give it to you at 900, which means I'm making a loss of 1 rupees. When the price is at 902, you're buying the stock worth 902 at 900, which means you make a 2 rupees profit, and I make a loss of 2 rupees because I am selling the stock to you 2 rupees cheaper. Similarly, at 903, you make a 3 rupee profit and I make a 3 rupee loss. At 930, you make 30 and I lose 30. Pay special attention to this 930 because in my mind this 930 is the worst case of where the stock will be on the 30th next month. Finally, at 960, you will make 60 rupees. Now let us put it all together. What is a call option? Call option is a right to buy a stock at a particular price. The price at which you buy is called the strike price. For example, INFOSYS 900 call is a right to buy INFOSYS at 900. INFOSYS 910 call is a right to buy INFOSYS at 910. In the first one, 900 is the strike, which is why it's called 900 call. In the second one, 910 is the strike, which is why it is called 910 call. You also notice that in these scenarios, the profit is all yours and the loss is all mine. Which also means an option is like insurance, because I am protecting you from the price rise and taking the risks on me. Which means the option buyer is actually buying insurance and the option seller is selling insurance to the option buyer. Now that I know I'm giving you protection or selling you insurance, I'm going to approach it like an insurer. When LIC insures your life, they take a premium for the risks they take. Similarly, I will ask you for a compensation here called the premium. In this case, it turns out to be 30 rupees. This premium is the price of the protection the option buyer pays to the option seller. This is paid in the beginning of the deal. Now here's an interesting question. Why 30 rupees? That is a number which I came up with. That is the option seller came up with. I guess the stock won't go up more than some 3%, or 930 rupees is the maximum level of the stock on the 30th next month. From the previous table, we know that at 930, my loss is 930 minus 900, which is 30 rupees. So if the stock price is anywhere under that number, I am safe. Hence, I arrived at the number 30. Now let us look at a few profit and loss scenarios for the buyer and the seller of the option. Scenario 1. INFOSYS ends at 960 rupees on the 30th of next month, which means you get to buy INFOSYS worth 960 at 900, which is a clean profit of 60 rupees. But you have already paid the premium, which is 30 rupees, so your net profit is 60 minus 30, which is 30 rupees. And I sell INFOSYS to you at 900 rupees. Assuming I did not have the stock with me, I bought it from somebody else at 960 and sold to you at 900, which means I make a loss of 60 rupees. However, I get the premium initially, which is 30 rupees, which kind of compensates me somewhat for the loss. So my loss is 60 minus 30, which is 30 rupees. Now let's look at another scenario. In this case, INFOSYS ends up at 910. You get INFOSYS at 900, which means you gain 10 rupees on the purchase of the stock for 10 rupees cheaper. But you have already paid the premium of 30 rupees, which means net you're losing money, which is 10 minus 30, that's 20 rupees loss. I sell INFI at 900 to you, so I make a loss there, which is 10 rupees. But I got the premium of 30 rupees initially. So in all, I'm actually making a profit, which is 30 minus 10, 20 rupees. This is interesting because in this case, you can see that the stock has actually gone up, but even then the option buyer has lost the money. That is because the buyer could not recover the whole premium, which means the stock should actually go up by at least the premium for an option buyer to make a profit on that 30th day when the exchange of the stock happens. Now let's ask another question. What happens if INFI is at 850 rupees on the 30th? Well, that's for you to think about. So let's move on to the next slide. Next, let's look at various scenarios of profit and loss for the both of us, this time with the 30 rupees premium in play. Initially there's an exchange of premium, which means I'm up by 30 to start with and you're down by 30 to start with. At 900 you lose the entire premium, I gain the entire premium, you gain nothing on the stock, I lose nothing on the stock, which means I make 30, you lose 30. At 920 I'm making a loss of 20 on the stock but gaining 30 on the premium, which leaves me with a net of 10. In your case, it's a gain of 20 on the stock, a loss of 30 on the premium, which leaves you with a net of minus 10. At 930, I lose 30 on the stock, gain 30 on the premium, you lose 30 on the premium, gain 30 on the stock, but both of us end up with a 0 loss, 0 profit. At 950, I gained 30 on the premium but lost 50 on the stock, which leaves me with a net of minus 20, whereas you gained 50 on the stock, lost 30 on the premium, which leaves you with a net of 20. At 1000, you make 100 on the stock but lose 30 on the premium, which leaves you with a net of 70. On the other hand, I've lost 100 on the stock but gained the 30 rupees premium, which leaves me at minus 70. Now let's take a very imaginary case in which the stock actually zooms to 10,000 bucks. In this case, you actually gain 9,100 bucks on the stock, and what you lost on the premium is hardly of any importance here. And I lost 9,000 on the stock, and my gain in premium, which is 30 rupees, is hardly anything to compensate for that. Now that explains why you look so happy in this and I look so sad in this. But the important takeaway here is this: whatever your gain is is exactly what my loss is, and vice versa. So it is what they call a zero-sum game. Another important takeaway is that an option buyer has unlimited profits and limited loss, whereas an option seller has limited profits and unlimited loss. That takes us to the last part of this video. When exactly do you buy and sell call options? Buy a call option if you think the stock price is going to go up. However, even if the stock goes up, as we have seen in a previous scenario, you need not make money. This is because you have to recover the premium which you have paid the option seller to make a profit on a buy call. So what does that mean? You buy a call if the stock will go up a lot enough to cover the premium. So when do you sell a call option? You sell a call option if you think the stock price will not go up. That is, it either goes down or stays where it is. If price does not rise, you will always make money. In fact, even if the stock price goes up a little bit, you'll end up making some money because of the premium you've made. So sell a call option if the stock will go down even the tiniest bit, or if it goes up by a very small amount.
That was an intro to call options, and in the next video we'll learn about put options. Thanks so much for watching. Bye.